Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome once again, Art Jarvis, for another edition of Taking Stock.
Hey, how you
Art
doing?
Jarvis.
Good to be here.
Good.
Good. Glad to hear it.
Happy to have you back for another edition.
Yeah, looking forward to it.
Well, you know what? And we're going to get right to it because, as you said, a lot has happened since our last edition almost 3 weeks ago.
Yeah, Mark, the economy and everything has been very busy. So.
The economy's been very busy.
That's right.
So what are the things? I guess what we end up talking a lot about is the economic indicators.
Sure.
And the reports that come out that help us understand what is going on with the economy and what those indicators are telling us. Yeah. So I know you mentioned to me while we were just chatting before, CPI came out.
Yeah, better than expected.
Which is what is that the consumer
price index? So that's what we.
Right.
So theoretically, that's what we pay as consumers. So,
all right.
So they were looking for a little bit above 3%, and it actually came in at 3%, which, once again, I think they're still shooting for 2%. The Federal Reserve is still shooting for 2%. But, a year or so ago now, I guess, we were at 9%. So the fact that we're at 3% is an improvement. Now, I'll stop him from saying that it's a good thing. Because we already had to suffer through 9% inflation for, a year. But,
right.
But it's the point is, and we've talked several times before, is you're looking at the numbers, we're looking at the economic reports and the indicators and things, and they continue to improve. So that's the good thing. The other one was the personal consumption expenditures index. That's the one that supposedly the Fed keeps a real close eye on as a inflation indicator. Yeah. And they were looking for that to be at like about 4.3, and it came in at 4.1, so it continues to drop also.
And I just came up with some alphabet soup, so personal consumption expenditures, which I just called the PCE.
That's the one, yep.
So is it referred to as the PCE?
That's the PCE, yeah.
Clearly I don't look at all the financial reports. That's your job.
That's right. Well, they throw all these acronyms at you, and you're like, what is that?
But now, so take me back again, because so the personal consumption expenditures was higher than they expected?
No, it was lower than they expected.
Okay.
So it also, and that's the 10,000-foot story is all the economic numbers that have come out since we last spoke have been better than expected, and they're improvements from a quarter ago, half a year ago, a year ago. So.
Except the PCE was lower than hoped.
Yeah, well, they wanted to be. That's another inflation indicator.
All right, I got it. Okay, that makes
so they were looking for So basically, our expenditures from a year ago, we were paying 4.1% higher than we were last year. But again, that number also was in the 9 to 10% range a year ago.
So going back to this PCE isn't a matter of like, hey, it shows me as a consumer my personal spending was up. It's saying my cost was up. So if it's lower, that's better.
Well, yeah. It's still up 4%, which means, again, we'll keep using the cheeseburger analogy. The cheeseburger went up 4%, right? Which is, we went through 9-10% inflation, and just round numbers, if we were paying $5 for a cheeseburger a year or so ago, and now we're paying $7 or whatever. So that hasn't changed.
$8.50.
Well, yeah. A $10 cheeseburger is no longer a $10 cheeseburger, right?
That's a fact.
Yeah, it's kind of crazy what we pay for stuff now. The other thing that came out was, to keep talking, we've always had these discussions about recession talk and things like that.
Right.
A couple of things. One is the gross domestic product number came out for the second quarter, and they were looking for it to be around 2%, and actually came out at up 2.4%. So it's actually stronger. The economy is actually stronger than what they were predicting, and that comes off of The first quarter they were at 1.1%. They moved that up to 2%. So, the numbers are stronger than expected. And this comes off, just several months ago, Fed Chairman Powell was talking about they were looking for maybe 0.1% growth year over year. Then that's how he talked about the potential for recession and things like that.
About almost 1.4% growth.
Yeah, it's 2.4
over the
because they were looking for 0.1,
right,
and it came out at 2.4. I mean, so they were
looking for 0.1, not 1 point.
Yeah,
okay.
Exactly.
Zero.
So we're way stronger than what we were talking about 6 to 12 months ago. So. And that brings up the other thing is now it's kind of interesting that we're starting to see the stories in the news and things that, maybe that recession that was a foregone conclusion isn't actually going to happen anytime soon. So, which...
Hopefully.
Well, you know what? The economy ebbs and flows, right? And so are we going to have a recession in the future? Most definitely. But don't forget what a recession is. It's 2 quarters in a row of declining gross domestic product or economic growth. So you could have 0.1% decline and another 0.1% decline, and technically you're in a recession. But then you start talking about how deep is the recession and the breadth of the recession and things like that. So you can have a recession and it not be some major event.
Well, and so sitting across from you having this conversation about recession ultimately is yes, it's going to happen. I don't like to hear that. But you soften the blow when you talk, well, it might be this and it might be that, over 2 consecutive quarters or whatever, and that's like, well, that doesn't feel too bad. But here's the thing: we do, whoever we are, me and others who just feel the impact, and we're not the financial analysts that you are, we're not the financial investment advisor that you are, or people like you are. So we just feel something. So when you talk about that inevitable recession, that scares me. What is the impact of that because ultimately you did say it depends on the depth and the breadth.
Sure.
So what's the one that I'll put it this way: how do you tell us that's not what's really coming? That deep, wide-ranging recession that is we're sitting here thinking, gosh, our parents or grandparents, or for some of these people listening right now, maybe your great-grandparents went through the Depression. We don't want to get to the edge of that.
That's most definitely. Yeah, and so 2008 was the Great Recession.
Right.
And we earned that. Let's put it that way. We were doing things in our economy and lending and things like that just shouldn't have been done. And I'm not sure we actually learned our lesson, to be honest with you, because you see a lot of the things continuing to happen that happened 10, 12 years ago. But yeah, that was 15 months of declining economic growth and declining stock markets and declining housing values, and it was hitting you from all sides, right? It's coming at you. Not only was your 401k dropping and your housing values dropping, and or maybe you lost your job on top of that. So it was ugly, and there was sometimes we work with some people that just to get them through that 15-month period, what ended up being a 15-month period, just to get them through without having to file bankruptcy and things like that.
Right.
And that goes back to the lending. We were so high credit card debt, and people had seconds on their houses and things like that. So they were loaded to the hilt with debt. And when you run into a recession and you have that much debt, it's a bad thing.
Well, how many times have people, even myself, how many times have I been told, or people like me, said, go ahead and extend yourself. Mm-hmm. There's nothing wrong with that until that happens. Right. And then, like you said, then you're struggling to make sure you don't. Being extended is fine with the idea, hey, the economy's growing, you're going to see increased income. Your growth potential for income is good. You're young, you're professional, you're whatever it is. You're in a good industry where salaries are going to get better, wages are going to get higher, and then that doesn't happen during a 15-month recession of 2008.
Right.
And so, like you said, how do you I don't want to dwell on 2008, but in terms of if something were to happen and we start to see a little bit of a recession, what are the things you do, like when you say you help somebody to avoid, the bankruptcy and get yourself through? What are some tips that you would give, say, here's how you carry yourself through when times get a little bit tough? What would be?
I mean, if you're looking from like a budgeting standpoint, if that's your question. I mean, it's really you take a look at the things that you're spending your money on. Okay, and if you're going to Starbucks every day and spending $4 on an iced tea, you probably should cut that out. Okay, so it's little things like that. Eating out.
I was going to say less dining out.
Yeah,
just
it's probably healthier.
Less entertainment dollar.
Yeah, I mean, and you tighten the purse strings, right?
Right.
And you do those kinds of things, and it's a thing, and you look at the debt. So I say this all. There's nothing. There's good debt and there's bad debt. Okay, there's nothing wrong with a little bit of good debt. There's a lot of nice things you can do. If I have a 3% loan on my house, on my mortgage, and I can make 7 or 8% return in the market, guess what? I'll take that 3% loan and hang on to it. If I have a 20% credit card, that's a whole different animal. You're not only that's that compounding of that interest on that credit card is what really kind of puts has the thumb down on you, and it's very hard to get out of that because you're making a monthly payment on that credit card and you're basically almost paying the interest.
Well, the quick tip there, I mean, just for a second on the credit cards is, pay your credit cards off.
100%.
Right?
Yeah.
Yeah,
there's people
because
out there.
That monthly payment is not what you planned when you got a credit card. It's like, I don't want a credit card payment. I have a car payment. I have a mortgage payment. Yeah. Maybe.
Yeah, and that's exactly right. And I mean, and that's when you start trying to look at some debt consolidation and things like that.
See.
There's credit cards out there with 0% financing that you pay to do the transfer, and if you can go for 12 to 24 months paying on a credit card where you got 0% interest, that helps a lot. It gets you a little bit further ahead of the game. But it's not a flick of the switch where everything's better tomorrow. It's a process.
Well, Art, that's the question, is what are the extraordinary measures you advise for somebody? And I don't mean that as most difficult, but extraordinary measures. Normal, ordinary measures are, hey, tighten the purse strings, cut back on the entertainment expenses. But the extraordinary measures are find debt consolidation. Yeah. Get rid of bad debt, high interest debt.
Correct.
That makes perfect sense.
And you run into people, and that's kind of the part of the concern right now with some of the things going on in the economy. But you run into people where let's say they have not such a great credit rating, and they don't maybe I get a 3% loan, but they end up getting a 7 or 8% loan, or I get a 10% credit card and they get a 24% credit card, because of their credit rating. It's very, very hard if your monthly expenditures are so much higher than the other person's because of your interest that you're paying on the same thing. Got to have a car, right? Well, they got to have a car too. But if I'm paying 3% and they're paying 8%, it's tougher on them and things like that. So, when we talk to kids in high school and stuff like that, we do talk a lot about credit scores and things like that. So if you can keep your credit score up, your life is a little bit easier. Let's put it that way.
That's a fact. Well, so the advice going in is take care of your credit.
Mm-hmm. Correct.
So anyway, that's kind of enough. We went a little bit longer than I hoped, but I apologize. That was my fault. That wasn't you. I just because if it's inevitable that there's going to be recession, that as we head in, even if it ends up being a soft one, some tips and advice for everybody out there to say, hey, if you start to see it, don't just lose your mind and get scared. Say, well, what are the steps I can take right now that'll help soften me? Yeah. Soften the effects of the recession and carry me through it. So that was the whole point.
Yeah, it's a good discussion. I mean, I think in the end it really came down to what you just said is take care of your credits. Take care of your credit score and take care of that. And that's, like I said, when we talk to kids, we really pound that in. It's like you're kind of starting with a clean slate. Get it up there quick, and then keep it up there.
Yeah. Well, and just because you can borrow doesn't mean you should. in terms of, go borrow for this and go borrow for that.
Yeah.
That's where you
Well,
get
again, good debt and bad debt.
where you get into trouble with the bad debt. So anyway, getting back on track. So since so many things happened, we kind of got past that PCE and the GDP. Where does that bring us to?
So all this has happened. The whole AI thing came out. That really gave the artificial intelligence gave the market a big kick. That all kind of kicked in. And last quarter, the S&P 500, which is kind of the large cap index for the United States, was up 11.6%. The equal weighted index, the non-capitalization weighted index that we've talked about in the past, was up 8.2. So it continues to lag behind a little bit, but it did catch up a lot kind of toward the end of July. You started to see a few trading days where the larger cap stocks like the Dow Jones and things like that index actually was outperforming the smaller cap indexes in the technology sector and things like that. So you kind of saw that spread starting coming back together. But yet still, we finished the quarter where there was still a kind of a separation between weighted and equal and non-weighted. But I think the other thing is which is kind of interesting to me, is the Fed raised interest rates another quarter point.
Well, I was going to say we're going to get, but again, as we go through that last piece, things are going in the right direction. Mm-hmm. Arrows are pointing upward, right? I mean, that's. Yeah. But so then here we go. You mentioned the Feds did raise the interest rate a quarter
point.
All right.
So they've raised it now at least 5.25 points. I think it's 5.5% now in over the last 15 months or so. And that I always use that's kind of like the Fed is tapping on the brake when you start doing a quarter point. They were doing 3/4 of a point before. That's pushing on the brake. Yeah. Now they're tapping the brake. So things are looking okay. I would personally maybe make the argument that they didn't need to do a quarter point, but I'm just some little guy from Loveland, Ohio, so no one asked me.
We're currently using the anti-lock braking system. Just tap, control the skid. Don't spin out.
And there you go. So now that the skids spin out, but they always talk about a soft and a hard landing, right? The goal is for the economy to have a soft landing. We don't go dipping down into that recession area, and kind of steady and get back into that growth and all that, and that's the goal. The big concern up until the last couple months was that they were stomping on the brake too hard. We were not going to have a soft landing. We're going to have an Elon Musk rocket landing, and which is not good. And that was going to push us into recession. So we kind of moved away from that. We got to remember that anything the Fed does, and some of these the impact of what they do really is seen more 6 months forward. So they're tapping on the brake today. What's that impact going to be 6 months from now? So that's what we have to watch, and that's what I was going to say. I wasn't happy with how they handled the interest rate situation here this last time around, but I start to get concerned that they're tapping on the brake a little bit too much, and then what's that impact going to be 6 months forward?
Well, at the end of the day, I mean that's the key thing is what will be the impact? What results from the moves that are being made? So you and I can only speculate today, or actually you can speculate today. All I can do is listen and say maybe that makes sense or it doesn't, because what do I know? But short version is right now, you feel like maybe there's a little too much tapping.
Well, again, it's a quarter point. Okay,
gotcha.
So but even a quarter point has an impact. If I'm a business owner and I'm looking to do projects or something like that, they just raised my cost of capital to do a project, right? So do I do the project? Do I not do the project? Coupled with all the other things I got to look at if I'm going to do that project. But also the stock market. If interest rates are very, very low, like they were, during the 2010s, you could support a much higher market multiple maybe in the 20s. Now we're at 5.5%, and that market multiple is not that a 23, 24, 25 market multiple, whereas at a lower interest rate might not have been unreasonable. Now today, that's a premium. and we're at if you're looking at forward earnings, which for the next 6 to 12 months, we're at 20 times earnings on a much higher interest rate level.
Yeah.
So them raising interest rates puts pressure on the stock market.
Yeah.
I mean, if they're raising rates and we want the market to continue to go up, then we need earnings to go up even more to keep that pace going. Does it make sense?
Yeah. Well, and
I got a little deep
where my mind is going, and listening to you and trying to understand. And then the other thing is, we're talking to investors and we're talking about investing. So how does that equate to return on investment for investors, or good investment strategies while they keep tapping the brake, even if it's 0.25%, and you're looking for those earnings to go up. They have to go up to continue the growth.
Right.
What's the impact for the investors? Does that slow the? I mean, I'm guessing it's simple. It slows the investment growth as well.
Oh, most definitely. I mean, that's the point. They're trying to pull money out of the economy, is what they're doing, which slows the investment growth. For this guy over here that's doing this project, that might just been enough to say, okay, we're not doing the project anymore, which means they're not making goods, they're not selling goods, they're not hiring people, all those things.
A whole domino effect across the board.
Precisely.
I got you.
And again, I'm not saying we're there. I'm not saying that we're in the stratosphere. But if I received new money today to go into a portfolio, I would probably be very, very strategic about how I place that money right now. Just because there's a little set of horns growing, but it's not a full set of horns right now because it's gotten too fast. It's gone too far too fast, in my opinion, in these last few months.
Well, we talked about that, about a month ago.
Yeah, sure did.
And a couple of episodes back. But
so 1 to 3, either time has to pass, earnings have to move up, or interest rates need to start moving down a little bit.
I got you.
But we're probably not going to see lower interest rates for a while now.
Well, so I'm sitting here, I see you. And people don't get to see this; they just get to hear us. But I get to see the facial expressions when you're saying, I'd have to be a little strategic with new money right now. And it's not. Sinister is the wrong word, but there's a secret. So you're not going to tell us exactly what those strategies would be.
Not exactly. Yeah. And again, for you or the person next door or the person on the other next door, those strategies would be 3 different things.
Right.
Because, you could be, a 50-year-old male, and you could be 3 different 50-year-old males, but guess what? You're 3 different 50-year-old males. So each portfolio will look different in some way.
Well, and my point, to your credit and to Jarvis Global, is when you say that, it's not like I have a secret. It's we're going to do the homework.
Yeah.
We're going to strategically place your new money.
That's right.
So that it has the best possible growth.
That's right.
Opportunity.
Yep, 100%.
That was a commercial for Jarvis.
Yeah, thank you very much. Here's your 20.
I was going to say you can leave a check on the counter on the way out the door.
This whole thing's a puzzle. I talk about this all the time. Yeah. This is what several things I enjoy about what I do. One is just working with people and helping them reach their goals. And the nice thing about being in the business for 35, 36 years is I have clients who are now retiring, and you're starting to see the fruits of that. Where we've actually gotten to the point where they're retired and they're traveling and they're doing the things they want to do with the money that's saved up. So it's fulfilling to start to see some of the things that you worked on for 25 years or whatever. But the other thing is the puzzle. This whole thing is a puzzle, and you think when you think you've got the puzzle put together, you're in trouble because someone's going to come along and scramble the puzzle.
Well, I always find that one piece.
Yeah.
Where does this go?
Well, yeah.
Wait a minute.
Or where's the missing piece?
It's usually when the puzzles that I'm talking about are usually like assembling something, and so then there's like a nut and a bolt or something. It's like, or a hinge. Like, anyway.
I'd say we were missing a few nuts and bolts right now. So
fair enough.
I'll leave it at that.
Well, anything else that you wanted to because I'm going to touch on something
Yeah.
to close us out today. But what else where else did you want to take us?
I think the only other thing I should mention about what's happened, we're in the second quarter earnings season now, so we're getting all those earnings reports. About 60% of the S&P 500 has reported now. 73% of those have actually reported better than expected earnings, which is a good number. If you look at like the 5 to 10 year number for positive earnings reports, that number is usually somewhere in the 70s. So we're good. We're not weak. We're not strong. It's good. Year over year for those earnings, we are up 9% year over year. So those earnings reports, actual reports of what has happened, are up 9%. The interesting thing though is we are seeing, first quarter was very strong. This quarter we're actually down 2% from where we were last quarter. So there is that, you are seeing some of that impact of that tapping on the brake.
All right.
Things have slowed down. There's no doubt. So, but have they slowed down so much that I'm worried that we're about to have a hard landing? No, I don't.
Well, I'm not going to take us there today, but in our next edition of Taking Stock, voice went away there. But in our next edition of Taking Stock with you, Art Jarvis, I want to talk a little bit about, what's going on politically and what one administration versus a previous administration, or, the policies and how they impact the economy, and what we're hearing from the current administration and what's the pushback on that. So
that might be a two-parter. We'll see what happens.
But we want to talk a little bit about that. So we'll both do our homework, I guess, and be able to, present what's happening in today's economy and the impact that the policies of this administration have had on that, and how it compares to the previous administration, or, as you know, it won't be long, we're coming up on election. But anyway.
Well, sounds good.
Perfect.
It'll be fun.
I'm looking forward to it.
All right. Well, I appreciate your time. I always enjoy this.
Art, it's a pleasure. Thanks for joining us for another edition of Taking Stock. And see you in 2 weeks.
Sounds good. Thanks, Chuck.
Take care. Bye-bye.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.